Now, for a closer look at the Fed's decision, I'm joined by economist Nicholas Economides, a professor at the Stern School of Business at New York University. So, interesting reactions to this rate cut. Who would you say this rate cut is good news for?
Well, a rate cut is always good news for the financial markets, but I think that the financial markets overreacted today. I expect that the Fed will proceed with one or two cuts in the fall. So it won't be contrary to most of the desires of the financial markets.
And this interest rate cut was expected, but as Jerome Powell said, it was more of an adjustment. The president and the U.S. markets clearly wanted a deeper cut and more aggressive pace of cuts. What's your take on the Fed's move today in terms of what they were looking at?
Well, the financial markets were looking for more of a statement that there are going to be a whole bunch of cuts. And Powell didn't deliver that statement, so there was this reaction by the financial markets. But when the news really sinks in, I think most people will see that it's likely that the Fed will continue with two rate cuts in the fall semester, sometime in September, October, November, December. So I don't think that, I would say that this is an overreaction and a short-term overreaction rather than the steady state.
So then what should we read into Powell's comments about this being an insurance policy for what might go wrong in the future?
Well, I think that the markets are used to models from Bernanke and Yellen, the previous chiefs of the Fed, where they would give the financial markets a specific model that everybody understood and therefore was well prepared about what is going to happen. Powell has failed to do that. And because of that, there is more uncertainty about about what his actions are going to be and how the financial markets are going to react.
Now, we know that Trump has repeatedly said that the U.S. economy has not been affected by the trade standoff with China, yet we heard Powell highlighting that that issue is among those that are dragging on the U.S. How would you describe the overall health of the U.S. economy?
Well, the U.S. economy is in excellent shape, but it sells stuff not only internally within the United States, and their demand is very, very strong, but also abroad. Abroad, in the European Union and China, there has been weaker demand. So that has affected manufacturing and production in the United States. So it's not like the United States is not doing well in terms of its own demand, but because it exports a lot of stuff, weakness in countries abroad affects the U.S. economy.
So for people at home who are wondering, why should I care whether or not the Fed has cut it by a quarter point or half a point? What should they be how should they be looking at this?
Well, I think that cheap money always drives higher the financial markets, but it has a lot of good effects. It prompts more borrowing, more expansion, and so on. It also has some bad effects. When interest rates are very low, there is a lot of speculation, like speculation in the housing market, speculation in commodities. So there are some parasitical effects of low interest rates. And that's why, in the long run, it's important to get to some higher interest rates. And in my opinion, higher interest rates should have been instituted from 2014, when the big financial crisis was practically over. But somehow, for various political reasons, both the present Fed chief and the previous Fed chief did not increase the interest rates on time, and the problem gets perpetuated. It's like an addiction. Once you have low interest rates, you want to stay there forever, but it's not healthy in the long run.
So then as we look at the Fed's role now, 10 years after the financial crisis, how does having less wiggle room prepare the country then if there is another financial shock to the system?
Well, I wouldn't worry about that. That's a kind of a low probability event, another big recession. I don't think that the Fed's policies today should be based on what it would do in cases there is a big crisis, which is a very low probability event. That's not really crucial for the present policy decisions.
All right, thank you so much, Professor Nicholas Economides there
Thank you.
from the Stern School of Business at New York University.